Are we in an AI bubble today? So with the S&P 500 hitting all-time highs, we're seeing all this bubble news coming up. So over here, we're seeing bubble fears. And then down there, we're seeing Evercore ISI, basically forecasting that the markets will hit around 9,000 points in 2026 if we reach bubble levels. And besides that, the S&P 500 valuation is also at a historical high. So during the dot-com bubble, for example, the forward P ratio reached around 25 times, and currently we're approaching that level as well. So we're currently at around 22.8 times, which was the high in the 2021 crash that we just recently had, and it is approaching dot-com bubble levels at around the 25 times earnings. So the S&P 500 is no doubt richly valued, and besides that, we're seeing quantum computing companies that are glorified research companies. And if you don't get the reference over here, on the right hand side, this is Arrow Time. It's with reference to Wolf of Wall Street, where the broker was selling junk stocks to all the people out there because of all this hype. So we're seeing something similar here with all these quantum computing companies. And besides that, we're seeing companies like AMD going up 28% in just one single day because of a piece of news. So the piece of news today is that AMD and OpenAI are having sort of like a collaboration. So OpenAI is going to have a 10% stake in AMD, and AMD is going to sell the chips to OpenAI as well. So we're seeing a lot of seller financing here, and we're seeing similar signs to the dot-com bubble. So during the dot-com bubble, a lot of your telecom companies, your hardware firms, they invested in each other's growth. So what they did was Cisco sold the routers to all these new dot-com companies. Then the dot-com companies will try and raise capital in the markets, and then they will buy more Cisco gear, and then Cisco will go up in stock price, go up in earnings. It was all artificially inflated, and that was sort of like a self-fulfilling loop until the dot-com bubble basically popped. So there was fake demand created at that point of time, and currently we're seeing something similar as well. So we're seeing all these companies over here, AMD, Nvidia, Oracle, OpenAI, all these companies are cycling their earnings and then buffing up each other's valuations. So there's an argument to be made that we're seeing some similarities with the dot-com bubble. So this is a graphic over here as well, showing whether or not we're in bubble territory. And if you're to compare it to Cisco in the dot-com bubble, Nvidia is currently not mispriced. It is still generally following its earnings. But of course, there's an argument to be made that the earnings could be inflated because all these different companies are trying to pursue data centers without actual ROI on it. So whether or not we're in a bubble, we are probably in the early stages of a bubble. We're not near peak yet. So if you're to compare valuations in the dot-com bubble as compared to today, we're still quite a fair bit off those valuations. Unfortunately, I'm not old enough to be able to witness those events. But during your 1999, if you look back, all these companies that changed their name to dot-com companies were hyped up in price. It was quite drastic at that point of time. So we're seeing something similar here as well. But of course, the valuations are a lot lower than what it was back then. We currently now have companies that are funding their own capex that are profitable. Whereas back then, all those companies, they were unprofitable companies. The juggernauts were basically quantum computing companies, research companies that didn't have real profits to back up their valuation. Howard Marks has also openly said that we're in the early stages of a bubble, and this is what he said.
Is there another time that this sort of reminds you of in any capacity?
Well, I guess, Lisa, the last time was probably around 97 when the market was kind of falling in love with tech stocks. And, the market was rocketing along. People were not worried about the level of valuations. People were extremely optimistic about the opportunities for the internet. Alan Greenspan famously cautioned that there might be irrational exuberance. Now I picked 97 because even though Greenspan was concerned about exuberance, the market went on to rise for another 2.5 to 3 years. Remember I said we're in the early days. We're not at a critical, at a nutty valuation. I'm certainly not ringing the alarm bells, as the quote that you had on the screen said. No reason to think there'll be a correction soon. But the point is that things are expensive. They may go on to become more expensive, but the fact that they're expensive, it should not be lost.
So opportunities are decreasing by the day with markets going up continuously, and it might not be a bad time for you to consider taking some off the table if you're too concentrated in all these different high beta names. But of course, there are still opportunities in the market today, like for example, you have ICE. This is Intercontinental Exchange. It is currently trading at a 30 times of earnings, and in the past month, this stock is down around 8%. So if you don't know what they do, they have three main business models. They have the data services portion, where they sell data to asset managers, they sell data to Bloomberg, Refinitiv, and so on. And it's basically a recurring revenue business that is highly predictable. So that's one portion. And besides that, they own the New York Stock Exchange as well. So when people trade more, when more companies have IPOs, it's a toll gate for companies to become a public company. So it's generally a great business model. The next company that looks interesting as well is FactSet. So FactSet over the past month is down around 26%, currently trading at a 17 times of earnings. I think for FactSet, it's a quality business, entrenched in the financial markets. So FactSet is normally the alternative to Bloomberg, and this is what they do, they sell data. So they are similar to your Bloomberg terminal, they're similar to Refinitiv. They sell data at a much lower price, and a lot of hedge funds, what they will do is they will pair Bloomberg with FactSet or Bloomberg with Refinitiv. So FactSet is irreplaceable, and this company is a highly recurring revenue business that will continue growing over the next few years. So if you're looking for a predictable company like FactSet with a valuation today that is at its historical low, then I think this company could be one that is interesting to look at. The next company as well is one of my holdings. It's Copart. So Copart over the past month is down another 9%, and year to date is down around 22%. So the stock is currently trading at a 27 times of earnings. And for Copart, the company is probably approaching a price that I would like to add at. So I'm looking to add at around $40 a share. That's when the stock looks extremely attractive. And for Copart, if you were to look back at the times when the management bought back a lot of shares, the management typically bought back shares at around 25 times of earnings. So back in 2019, the management bought a lot of shares during this time when the stock fell by quite a fair bit. Similarly, in 2022, the management bought back shares, and currently now we're approaching that valuation as well. So the company has a lot of cash. The company has around 12% of its total market cap in cash. So if we're able to see that cash position getting deployed into buybacks, then this could boost their EPS in a very short, and this could heavily bump up their EPS in one single quarter. And for Copart, this could be a potential catalyst for the company. As for my portfolio today, I currently hold around 28% cash, and I think that is a comfortable figure to sit at right now. So my cash position is relatively large. I'm looking to maintain my cash levels. The markets feel a bit frothy, and if it goes up, I have the 70% that is running for me. But of course, if the market falls, then I have the 30% to basically deploy. So patience is key here, and I'm not looking to add companies at crazy valuations today. Last portion, I'll be covering some questions left in the comments. So the first one, it says, thought you might include Amazon in the list. So this is with reference to a video where I was talking about what companies to look at right now. And for Amazon, I think it's a company that is probably trading at fair value. It's a company that isn't outrageously undervalued. Google a few months ago was quite undervalued. It was at around a 16 times of earnings at one point. Amazon is nowhere near that valuation today. It is still trading at a 33 times of earnings, as crazy as it seems. So although the stock is down year to date, I don't think Amazon is a stock that is amazing at this current valuation. I think there are better companies out there, and that's why Amazon wasn't included in the list here. But of course, if this AI bubble continues to expand further, then Amazon will definitely benefit from it through their AWS portion and through their multiple business lines. The next comment, it says, "Hi Guan, you don't own any railway stocks. Can you please give your thoughts on railroad companies in general? Chris Hone owns at least two. Do you see railroad stocks differently than he does?" So for me, I think railroad companies are predictable companies, of course, but there are a few things to note. So number one, they're highly capital intensive. And number two, they're susceptible to trade relations as well. So we saw what happened when Trump imposed his tariffs. When Trump imposed his tariffs to Canada, to Mexico, and so on, all these railroad companies, they had their earnings affected. They stated in their management calls that the trade between those companies were crucial for their earnings potential, and that is one portion, that is one worry for all these different railroad companies. Besides that, they are highly capital intensive as well. So besides having to build out all the railroads, having to expand the railroads, all these railroads don't have extremely high margins because there's a lot of costs tied to running all these railroads. So you have human capital cost, which is ever rising because labor cost is extremely high. You have energy costs, and some of your railroad companies are also tied to energy as well. So that is another cyclical factor that you will have to consider. So for railroad companies, while some of them look attractively priced, I don't think it is time to add right now, unless the companies become outrageously undervalued. And I don't think this is an opportunity for you to add, because all these companies, they're not particularly high growing anyway. For me, I'm staying out of these railroad companies for now. Last portion, I have this X account here, and I'll be writing up some stuff here, so feel free to look up this X account if you're interested. I hope you guys have found this one useful and invest safe.